Hello everyone, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. In this video we are going to quickly revise the special income tax rates, the special surcharge provisions and also the new tax regime under section 115 BAC for CA intermediate income tax examinations. Now without further delay, let us begin with the revision. Firstly, let us discuss the special income tax rates for CA intermediate. Firstly is the section 115 BBE, which talks about income. Unexplained income, which we studied in chapter number 1 in under section number 68 till section number 69D. And for all those incomes, I have already told you that the tax rate is 60% plus 25% surcharge plus 4% health and education cess. Then we learned section 115 JC in PGBP chapter, which talks about alternate minimum tax, that is AMT. One special point about alternate minimum tax is that it is not applicable for section 115 BAC, which we are going to study now, and it is applicable to all the assessees other than companies. What is the alternate minimum tax rate? 18.5%, and for International Financial Service Center it is 9%. We learned in depth about alternate minimum tax, and that concept is discussed in revision videos of PGBP chapter. Then we studied in capital gain chapter about section number 111A. Generally, short-term capital gain is taxed on normal tax rate. However, 111A has a special tax rate, that is 15%. Now, what is covered in 111A? Short-term capital gain in case of equity shares of a company, units of equity-oriented fund, and units of business trust on whom the STT has been paid on transfer. So, if there is short-term capital gain on these assets, it will be charged at a flat rate of 15%. Then we learned section 112A, which is similar to 111A, but it is a case of long-term capital gain. So long-term capital gain in case of transfer of equity shares of a company, unit of equity oriented fund and unit of business trust on whom STT is paid on transfer, and in case of equity shares of a company, the STT should be paid on acquisition also. In such case, the long-term capital gain is taxed at a flat rate of 10% on the income above 1 lakh rupees. That is, on the first 1 lakh there is no tax. On the income above 1 lakh, that is 10% tax. And here, while putting the cost in the capital gain calculation, you should also remember the grandfathering clause, as I told you in the capital gain revision lecture. Okay. Then we learned section 112. So all the long-term capital gain other than section 112A will be taxable under section 112, that is a flat rate of 20%. Generally it is 20%. In some special circumstances it is 10%, which I had discussed in the capital gain revision itself. Then we discuss in income from other sources about section 115 BB, which talks about casual income or winnings income. So if there is any winnings from lottery, crossword puzzle, horse race, card games, any other games of any sort, gambling, betting, etc., then on such income tax is charged at a flat rate of 30%, and then surcharge and health and education cess as applicable usually. Okay, so this is winnings income. And one more special point about winnings income, I told you that against the winnings income no deduction is allowed, no expense is allowed, no chapter 6A deductions is allowed, and even losses are not allowed to be set off. Then we, in the capital gain chapter itself, we learnt about section number 46A, which talks about buyback. So when a domestic company is buying back its own shares, when it's giving money to the shareholders, it will deduct the buyback tax and give it to the government. What is buyback tax? Tax on buyback. How to calculate the tax? Answer is on buyback price minus issue price. You have to calculate 20% plus 12% surcharge plus 4% health and education cess. So you will get the buyback tax. Okay, so these were the special rates of taxes. Then we started discussing about the special surcharge rate. I told you that for dividend income, 111A income and 112A income. What did I tell? Dividend income, 111A income and 112A income, maximum surcharge can only be 15%. Hence, what did I tell? Firstly, when you are solving the question, you see what is the total income. If the total income is greater than 2 crores, then you see this particular table. In this table, what is given? You have to see what is the income other than 111A, 112A and dividend income. If the income other than 111A, 112A and dividend income is up to 2 crores, then on the entire income, 15% will be the surcharge. If the income other than dividend, 111A and 112A is more than 2 crores but up to 5 crore rupees, then on the normal income, surcharge will be 25%, and on the dividend, 111A and 112A income, the surcharge will be 15%. Then if the income other than dividend 111A and 112A is more than 5 crores, then on the dividend on the income other than dividend 111A and 112A, the surcharge will be 37%, and on dividend 111A and 112A income, the surcharge will be maximum 15% only. Then we also solved a question where I told you that other income as well as dividend income both together are taxed at normal tax rates. Hence, you have to find out dividend tax by using proportionate method. So first, what did we find? We found out 112A tax, okay, and then on that we had applied the surcharge. Then we found out of 15%. Then we found out 111A tax, and that on that tax also we found out the surcharge. But however, dividend income is mixed with the normal tax rate. That is why for other income and dividend income together we found out the tax, okay. Then the tax we have to split it into two parts. What two parts? First is the tax on income other than dividend, then tax on dividend income. How to find tax on dividend income? Tax on dividend income is equal to tax on the normal tax rate income including dividend divided by normal tax rate income including dividend multiplied by dividend income, which is basically a proportionate formula. So after applying this formula, you will find out the proportionate tax on dividend. Then the balance amount will be the tax on other income. On tax on other income, apply 25% or 37% surcharge as the case may be. On tax on dividend, you can apply 15% surcharge. So you will find the total surcharge. Then add all the taxes and surcharge together, you will find the total tax. On that, you can add the health and education cess and then round it off to find out the final tax that is payable. I hope you are clear with that surcharge provisions. Now let's talk about the new tax regime under section 115 BAC. So now for a taxpayer or the assessee, there are two tax regime. One is old tax regime or the normal tax provision, and new tax regime, which is also section 115 BAC, which is given in section 115 BAC. Firstly, for whom and all this 115 BAC is applicable? Answer is individual and HUF. It does not matter if the individual is a resident or non-resident. Okay. Then on what is this section applicable? Answer is on total income other than special rate income. On total income other than special rate income. If there is a special rate income, for example, 111A, 112, 112A, 115BB, 115BBE, etc., then on such special rate income, as usual, the special rates are going to apply. There will be no change. However, on the normal tax rate income only, the taxation method will change. Taxation method will change. So how to find out the tax? You have to apply the slab rates. Here the slab rates are different. What are the slab rates? Up to 2,50,000 no tax, okay. Above 2,50,000 up to 5 lakh 5%. Above 5 lakh up to 7,50,000 10%. Above 7,50,000 up to 10 lakh 15%. Above 10 lakh up to 12,50,000 20%. Above 12,50,000 up to 15 lakhs 25%, and above 15 lakhs 30% tax. That is, as and when 2,50,000 amount is increasing, 5% is keeping on increasing till it reaches 15 lakhs. After 15 lakhs, the tax will be 30%. And special tax rates will always be as usual, like how we studied before. And here one point that you should note is that there is no extra basic exemption limit for senior citizen and super senior citizen. So even if a person is a resident senior or resident super senior citizen, for them also the basic exemption limit will be 2,50,000 under the new tax regime, that is 115 BAC. After calculating the tax Nokana, the surcharge and health and education cess 87A rebate etc. everything will be applicable as usual how you studied in the old tax. Okay, that is the normal tax provisions. Now here if you see Nokana, the tax rates are lower than the normal tax, because in normal tax there are only three slabs, 5, 20 and then 30 directly. But here you have so many slabs, and only on the income above 15 lakh rupees you are going to pay 30%, whereas in the old tax on income above 10 lakhs you are going to pay 30%. Now why is the government giving the lower tax slab benefit? Because the government is snatching away so many exemptions and deductions that is given to the assessee. So what are the different types of exemptions and deductions that has to be given up if the person has to choose new tax regime? Hence, if the person is choosing the new tax regime, that is section 115 BAC, then that person cannot take the benefit of section 10 clause 5, that is leave travel concession, which we studied in salary chapter. Then 1013A benefit not available, that is house rent allowance, which we studied in salary chapter. Then section 10 clause 14, we studied two parts, section 10 clause 14 subclause 1, section 10 clause 14 subclause 2. Both subclauses are not applicable for the new tax regime. However, only 4 exemptions are still applicable. What are those 4 exemptions? Transport allowance, conveyance allowance, travel allowance and daily allowance. Tell one more time. Transport allowance, conveyance allowance, travel allowance and daily allowance. These 4 allowances are exempt both for old tax also and new tax also. Okay, it does not make any difference. Then section 10 clause 17, daily allowance and constituency allowance given to MP and MLA was exempt, but in 115 BAC it is not exempt. Then section 10 clause 32 is the exemption given for minor child, that is also not allowed in 115 BAC. Then section 10AA deduction, which is given to special economic zone, is also not applicable to 115 BAC. Then section 16, there are 3 deductions in section 16 that we studied in salary chapter, that is standard deduction, entertainment allowance and professional tax. All the 3 deductions are not applicable for new tax regime under section 115 BAC. Then in house property chapter we studied section number 24B, which speaks about interest on housing loan. Now listen carefully. Interest on housing loan is allowed as usual in the case of the let out property and deemed to be let out property. So there is no difference for LOP and DLOP. However, for self-occupied property, that is SOP alone, interest on loan in respect of self-occupied property is not allowed in case of 115 BAC. Okay. Next, in PGBP chapter we learnt about additional depreciation. If conditions are satisfied, then additional depreciation is given to the assessee. Correct. However, if assessee chooses 115 BAC, no additional depreciation will be provided. Now let's come to scientific research deduction. Scientific research deduction, in that we learnt 2 types of scientific research deduction. One is in-house research and number 2 is contribution. In-house research deduction is always allowed. It is allowed in old tax regime also, new tax regime also. However, the contribution to scientific research institution is not allowed under new tax regime under section 115 BAC. Okay. Then we learnt about section 35 AD, that is specified business. So 35 AD deduction also not allowed under section 115 BAC. Then 35 CCC agriculture extension project, that is also not allowed for 115 BAC. Then in income from other sources we learnt about deduction for family pension. You remember 1/3 of family pension or 15,000 rupees, whichever is lower, that deduction is not allowed if the family member is choosing 115 BAC. Next, all the deductions under section 80C to 80U that we studied in chapter number 6A deduction. Okay, it is not allowed for 115 BAC. However, only 2 deductions are allowed. What are they? 80CCD subsection 2 and 80JJAA. So 2 deductions, that is 80CCD subsection 2 and 80JJAA, are allowed for old tax also, new tax also. All the remaining deductions are allowed only for old, not allowed for new. Okay. Next, now let's talk about the losses. Okay, certain losses which with respect to the portion that we studied earlier is not allowed to be carry forward. So listen here. So set off or carry forward of loss or depreciation from any earlier assessment year if such loss or depreciation is attributable to the any of the deductions referred to in 1 above. So we learnt section 35 AD specified business, or we learnt additional depreciation. If any loss is arriving to the assessee because of all these items, then such loss also cannot be carried forward. Now there is one special point about additional depreciation. Listen here, see here. If there is any unabsorbed depreciation in the business, let's say it is 10 lakh rupees, in that there might be normal depreciation. That unabsorbed depreciation might also contain some additional depreciation. If the unabsorbed depreciation contains additional depreciation, then such additional depreciation, okay, that is contained in unabsorbed depreciation, you cannot carry forward. Hence, only how much you can carry forward? You can carry forward only 6 lakhs. You cannot carry forward 4 lakhs. Now, since you cannot carry forward this 4 lakhs, you have to add back the 4 lakhs in the opening WDV of the block. Okay, so add back in the opening WDV of the block. Next, one more point in set off and carry forward of losses is that inter-head adjustment of house property loss will not be allowed under section 115 BAC. Only intra-head adjustment can be done, inter-head adjustment cannot be done for loss of house property. Okay, now let's talk about depreciation or additional depreciation. So if there is any block of asset which is entitled to more than 40% depreciation, then maximum how much depreciation will be allowed? Only 40%. I think we learnt only one case where If during a specified period a motor vehicle is hired, then 45% depreciation is allowed. Hence, for that case alone, 40% it has to be restricted in the new tax regime. If you see the PGBP chapter, you will be able to link and relate. Next, AMT I already told you, it is not applicable for new tax regime. Now, since AMT is not applicable for new tax regime, what will happen? Old AMT credit also cannot be carried forward. Hence, while solving the question, you have to also consider whether old AMT credit is there or not, and you have to use that in your decision making purpose. Okay. Now, similar to section 115 BAC, there is section 115 BAA for the domestic companies who can opt for concessional tax of 22% plus 10% surcharge, 4% health and education cess, and effectively it will become 25.168%. Similarly, 115 BAB is also another section in which the benefit is given to domestic manufacturing companies. So if they satisfy the condition given in that section, their tax rate will become just 15% plus 10% surcharge plus 4% health and education cess. And similarly, there is one more section called 115 BAD, which is there for resident cooperative society. If they satisfy the condition given in that section, they can opt for concessional tax of 22% plus 10% surcharge plus 4% health and education cess. So special tax regime or new tax regime is also applicable for companies as well as cooperative society. However, you need not learn in detail. You just know what is the reduced tax rate, that is enough. Okay. Now let's come back to section 115 BAC, that is related to individual and HUF, and let us see some special points. Special point number 1. After opting for section 115 BAC, if subsequently the individual HUF is not satisfying the condition, then 115 BAC shall be invalid and normal provisions shall apply. So if you have taken 115 BAC and if you do not satisfy the condition, then automatically you will be converted to old tax regime. You get my point? Next, individual or HF who does not have any income under PGBP would have the option to choose either of the two options every year based on their liability. Hence, if there is an assessee who is not having any PGBP income, such assessee can choose between old tax and new tax every year. So every year I will calculate what is my total tax under the old tax regime and also under new tax regime, and whichever is less I will opt for that system. Okay, because every year I can keep on changing. However, if an individual or HUF is having an income under head PGBP, then option once exercised cannot be withdrawn. Once exercised, it shall be applicable for all subsequent assessment years. However, if the option is withdrawn, then the individual or HUF shall never be able to exercise this option again, except where assessee cease to have income under head PGBP. So listen very carefully. If there is an assessee who is having PGBP income, then if such assessee opts for new tax regime, they can never come back to old tax regime. If they opt for new tax regime, they can never come back to old tax regime. However, sometimes what will happen, they will not satisfy the conditions, correct? If because of not satisfying condition, if they come back to old tax regime, then permanently they should stay in the old tax. They can never come back to new tax regime. You get my point? Listen one more time. If a person is having income under head PGBP, then such person can opt for new tax regime. After opting for new tax regime, it will become permanent. It cannot change. However, if conditions are not satisfied, what will happen? New tax will be converted to old tax, correct? If it is converted like this, then after that you can never take the new tax regime ever. Okay, till you have PGBP income. So till the assessee is having PGBP income, he can never take back the new tax regime. If there is no PGBP income, one more time the options will come. Any of the two options can be chosen every year. Now let's talk about employer-employee relationship. If an employee wants to opt for section 115 BAC, he may intimate his employer every previous year. If such intimation is received, employer will deduct TDS under section 192, keeping the new tax regime, that is 115 BAC, in mind. However, if no intimation is received by the employee, then employer shall deduct TDS as per the normal tax rates. Hence, if employee is going to the employer and telling, please deduct my TDS in new tax regime, then employer will deduct new tax regime. If employee does not tell anything, employer can deduct under old tax. Okay. Next step. Now, what happens if employer has deducted the TDS under new tax, but now last moment employee wants to change to old tax while filing the return of income? Is it allowed? Answer is yes, it is allowed. So while filing the return of income, if the employee wants, he can change the option also. Okay, so whatever option is chosen while filing the return of income, it will be the final option. Next, however, if employee is having income under head PGBP, then he cannot deviate after filing the return. So a person might have both salary income as well as PGBP income, correct? Earlier I told you, if a person is having salary income and TDS is deducted, he can choose between old tax and new tax. But if such employee is also having PGBP income, in such case, if he chooses for new tax once, he cannot deviate from new tax. He also always has to be in the new tax regime, which I already told you.
Now let's come to changes in special tax rates. In special tax rates, there is only one change, that is in alternate minimum tax AMT. Earlier, we learned that alternate minimum tax rate is how much? 18.5%, and in case of International Financial Service Center, that is IFSC, the rate is 9%. But now for cooperative societies alone, AMT rate will be separate, that is 15%. Hence AMT, that is alternate minimum tax for cooperative society, the rate will be 15%. Fine. So this is one change, and then final change in the tax rates section is the change in special surcharge. Earlier we learned that for dividend income, that is in income from other sources, then 111A income, that is short term capital gain, that is taxed at 15%, and then for 112A income, that is long term capital gain, that is taxed at 10% on income above rupees 1 lakh. So for these three sections, the maximum surcharge on the income would be 15%. But now one change has been brought where even section 112 has been included in this highest surcharge bracket. Okay, 112. What is 112 Kanna? Normal long term capital gain. Okay, so now for all the long term capital gain income, the maximum surcharge can be how much? 15%. I am not going in depth because we have already covered this section, and if you want to revise it, you can obviously watch the revision lecture. Okay, so in this table, what I want you to do is, along with dividend income, 111A income and 112 income, you should also include section 112, that is normal long term capital gain. You get my point?
So these were the provisions of the new tax regime. I hope you are clear with the special tax rates, new tax regime, and also the lower surcharge of 15% for 111A, 112A and dividend income. Kanna, exams are near. Keep learning, keep revising, and senjiranga exams la. Take care. Bye bye.